Good morning, Oracles. So for the foreseeable future, it is more important to focus on quantity of shares than share price. Now what I mean by that is we're basically going to be range bound most likely for probably the next year. And when it comes to range bound, I don't mean range bound by price. I think ranges right now are going to be bound by PE compression due to the Fed raising interest rates. So what you're going to have to follow, and you can do this with any other stocks that you're investing in, is take a look at their PE ratio. When we are in a rising interest rate environment like we currently are, PE is going to compress. We discussed this in several videos over the last few days. So if you want to check those out, go right ahead. I've got them in the link in the description. So when we're looking at the PE compression dropping, let's take Tesla for instance. You have to go quarter by quarter to take a look at their earnings. And so right now, based on Friday's trading close price, we're looking at around 137 PE ratio. And so that's going to continue to compress down based upon the interest rates going up. Nothing wrong with Tesla whatsoever. Nothing wrong with the fundamentals of the company. It's just the macro environment is that heavy right now that it's pulling everything down. And so with each quarter that we go through, we will get new earnings, which will then adjust to whatever the PE ratio is versus where we are for interest rates. This is just how it's going to go for the rest of the year, as long as the Fed is going to be raising interest rates. But of course, we see the fluctuations up and down as we have seen in the first quarter, and it's all based on, the sentiment in the market. But those ranges that we swing up and down to are all bound by where we are at for interest rates and the compression in the PE. So this is just something that I have been tracking and following. I could be wrong, maybe it's just a freak coincidence, but it just seems that, over history, when we have interest rates going up, PE compresses, and so when you have that PE compression, you're going to see this range-bound effect going for each company that you're invested in. And so this is partially why we see the dead cat bounce action going on in the charts. And a dead cat bounces, when the stock comes down, then it bounces up a little bit and comes back down. And so that's what a dead cat bounce is. And every single time that's happened, it's because we've gotten news from the Fed about rates going up. So it doesn't have to trade based upon, the actual rates going up. What we have seen this year is usually it trades based upon what the rumor is. And so we'll sell off based upon the rumor. And then as we saw in March, we actually shot back up again when the reality hit because everything was already priced in. So we see these bounces happening as soon as we get rumor of news of the interest rates or what they're going to be, 50 basis points, 75 basis points. We then drop accordingly and PEs compress accordingly based upon those rumors. And so then what ends up happening is the stock price is going to trade according to all of that range-bound information based on interest rates and their PE ratio. So again, this has nothing to do with the company fundamentals, it's just how the entire market is trading in these current conditions. So this is why we say fortunes are born during bear markets, because as we are compressing, this is when we have an opportunity to build up the quantity of shares that we have in our portfolio. The price keeps coming down, we keep on adding more. So what are the strategies that we can use to add as many shares as possible to our portfolio? Well, one is you can just buy everything that you can right now at every chance you get, and then just let it ride. If you're going to be holding Tesla long term, many of us on here are going to be holding it for a minimum of 10 years. If that's the case, then ask yourself, what do you see the price being 10 years down the road? If you see it being $12,000 per share, do you really care if you buy it at $1,000 or $600 now? So if you're happy with buying at whatever price you're buying at because you're going to be happy with the gains that you will have in 10 years, then just buy and hold. And there's nothing wrong with that, and you'll get through this. And then if you see any opportunities that you want to buy in the future, just buy more. A second strategy would be timing the market. That is very difficult, and very few people can do this. And if you can, it's probably because you're from the future or you are psychic. So chances are, if you're trying to time the market, it's nearly impossible. I did make a video recently about different times of events that could be going on that could swing the market one way or the other. But again, these are just based upon news predictions. Not factual information, nothing is guaranteed, but these are historically moments where we see the stock swinging up and down, so it gives us a better opportunity and a chance to get in at lower prices. So you can follow charts and try to time things that way, and maybe you do get in at a little bit lower price. Maybe you get lucky and actually time the bottom. Somebody actually over on Twitter had been tracking all of my trades, which if you don't follow me on Twitter and you're over there, I'm at Oracle Tim 1, and I do put all my trades there. And they've been actually tracking all of my trades, and thank you for whoever was doing that. That's awesome, because they've seen that I would have made very significant gains based upon my trades. And I just dollar cost average. So I have my own strategy, which we'll discuss in a moment. But if you want to try to time the market, you can do that and accumulate more shares by timing the market if you want to try that strategy. And the third strategy, which is the most tried and true, is dollar cost averaging. Now, as I just alluded to, that's how I play this. I add to Tesla every single day. I have the luxury here in the US where we can do fractional trading, so I don't have a lot of money. I put in $15 every day into Tesla, and then for every percent that it drops that we're over $1,000 currently, I add $5. Between 900 and 1,000, I will add $10, and then anything that we get below $900 for every percent that we drop, I will add $15. I've adjusted my strategy over the last few months based upon how we've been trading and how quickly my money had run out the first time with my dollar cost averaging. So that's my strategy right now, and it has been working out very well for me. This is how I've been able to accumulate as many shares as I have gotten up to. Currently, I have just under 8 shares. I don't have a lot, but that's how I've been building it up, because I started this channel back end of September with 2 shares, and now I have almost 8. And it's just because I've been dollar cost averaging this way all along the way. That's my strategy. If you are from another country or you cannot fractionally trade, take a look at the other video that I had made about just the timing of the market. And again, it is not financial advice, it's not guaranteed, but based upon what we have seen, you can at least see kind of the swings that the market could be taking, which could potentially give you opportunities for lower prices. So take a look at that, and I know some of you also from other countries do have to pay, transactional fees every time, and that can get pricey. And buying once could be more financially wise than doing it several times in another dollar cost average type scenario. So, for your own portfolio and for your own situation, you've got to do your own due diligence to make sure and decide what's going to be best for you individually. But those are 3 strategies that I have known to use. I do try to time things here and there with my IRA. I do try to use my strategy when it comes to timing of the market and the waves that we're in to try and accumulate more shares. Because trying to time the market like that, if you do sell, if you're doing it in a manner where you're trying to sell the top, you do have to pay capital gains taxes. In my IRA, I do not. So I've got that benefit there, trying something different. And again, that is very risky, but it's something that I'm trying to accumulate more shares as we're going through this range-bound cycle that we are in. And now you may ask, well, why don't we just wait until the Fed stops raising rates if everything is going to continue to compress? We'll take a look at Tesla's earnings. They have been blowing earnings out of the water, and their earnings keep on growing exponentially. So as they're growing exponentially, their earnings may actually outgrow the interest rates that are going up, which could then in turn keep the PE ratio higher in that range that we're in. So, we might actually stay around that $900 to $1,100 range just because of the fact that Tesla's earnings are growing faster than the interest rates are going up. And then as we get further on down the line, if the Fed is front-loading interest rates now, as we get to Q3 and Q4 of this year, they may only do 25 basis point hikes, which means that the compression of the PE isn't going to be as strong as it is now, which will then allow Tesla and the stock to grow even faster. And this is why I maintain my price target for the end of this year of $17.25, because I think that as we get to that point, earnings are going to be significantly higher at that point, and the Fed interest rates are not going to be going up as fast, so we'll have a chance to outgrow them significantly. And now we can also talk about a potential recession coming up. What happens if we get a recession? Alan and I were having a discussion in the comments about, a stock market crash coming and the S&P pulling back about 25%, which for me, if we hit a recession, that's most likely somewhere we're going to get to, is correcting about 25% in the S&P. So again, we don't have enough information right now to determine whether that's actually going to happen or not, but it is on my radar as a potential possibility. So if we get to that scenario, we will obviously compress even more. The stocks will probably pull back significantly more, and then we'll have an even greater opportunity to build up our quantity of shares at that point. So the reason I'm not just waiting for that to happen is because it is not guaranteed. I will still continue to dollar cost average along the way. I will continue to look for different avenues of cash flow generation to bring into myself. So just in case we do get to that point where we do hit a recession and get a 25% correction in the S&P, I will have more cash flow coming in from the outside to be able to build up my quantity amount even faster and higher. And so to look at the two different ends of the spectrum that we could be on, first is the Fed actually pulls off a soft landing when it comes to interest rates and inflation. They pull inflation in line, they get interest rates back to where they want them to be, and we do not get a recession. If that is the case, then we probably have ourselves about an 8 to 12 month window where we will have this range-bound scenario where we continue to accumulate and add as many shares as we can, and as soon as we get to the end of that, we will be able to hit growth again, and then PEs will grow again, which means that Tesla will skyrocket. And now on the other end of the spectrum is they do not get us a soft landing for the interest rates, and we do end up going into a recession, and we get an S&P correction of 25% or more, bringing the entire stock market down, which in that case, we still have an opportunity to continue to add to our shares, and we might end up getting maybe a 2 to 2.5 year window where we will have that range-bound scenario, and the range might actually be significantly lower due to the recession. Then, once we come out of that recession, again, the same scenario, Tesla will skyrocket. So this is why adding and accumulating as many shares as possible right now is vital and important to your portfolio if you are one of the mindset that Tesla is going to really skyrocket in the future and you see amazing growth for them. Now again, I'm not a financial advisor. I'm not telling you guys what you should do. I'm just merely stating what I am doing and the different things that I look at and all the different things that I question along the way. Such as when Alan had questioned, my thoughts on this. I appreciate that because it does give me a good range of scenarios that I can play out in my head to be more agile and ready for everything. Because if all I thought all the time was everything is going to be sunshine and roses, then when all of a sudden things went dark, I would be left holding the bag. And I don't want to be left holding a bag. I want to be ready to handle any situation. I've been many times in a situation where the stock pulls way far down and I don't have any money to invest in it because I had dumped everything in. And I wasn't upset, I just had to hold through it. I just wish I had a little more cash on the side to be able to buy a little bit more at a little bit lower price. So this is why I use my dollar cost average strategy. I will always have that cash on hand to continue adding. I will always be able to, buy every time we dip. It keeps going down. When we do go into the dumps, I am always ready to buy more while we're down there. And so I'm always happy regardless of the price is up or down. Now again, I would love for the stock price to skyrocket. I would, it's always great to see your stock in your portfolio going super green, but you gotta be realistic, and realistically, this is just the scenario that we are in. We saw on Friday, after the earnings that we had gotten on Wednesday, that the macro environment is just way too strong for the company individually and fundamentally to be able to outweigh that. Tesla did prove that they were strong and they, did way better than the market did, but still, if the market wasn't as bad as it was right now, the stock would be over $1,100, but we're not. We're barely over 1,000. So this is just the reality of our situation. But that reality is giving us amazing buying opportunities right now to be able to accumulate as many shares as we possibly can. And now once we do get the split, it's not going to change the valuation of your portfolio or the company at all. It's just going to change how many shares you have. And of course, that's another great way to accumulate as many shares as possible is, have as many shares now before the split. And then after the split, it'll make it easier for all of you who cannot fractionally trade to be able to add more shares to your portfolio as well. Let me know in the comments below, how many shares do you have in your portfolio? I'm currently between my two portfolios, my main portfolio and my IRA. I'm just south of 10. I want to get to 10 in my main portfolio prior to the stock split, which no, we do not have any news on yet, but hopefully we will get that in the next week or so. But let me know in the comments how many shares you guys have, how many you're looking to accumulate, and how many you need in your portfolio to be able to retire. Thank you all so much for watching. I appreciate all of your support and feedback. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am over on Twitter at OracleTim1. I share all of the latest Tesla news, pertinent stock market information, and all of my daily trades. Thank you so much. Have a great one.